about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Shah and you're watching IndianOpen. Let's go straight to the headlines at this hour. The US Federal Reserve hikes rates for the fourth time this year, trims the 2019 rate hike forecast from 3 to 2. The government will announce a new recapitalization plan for public sector banks as early as today. Minutes of the previous Monetary Policy Committee meeting indicate that members unanimously chose to pause action due to volatility in previous inflation data. And Flipkart is open to acquire a content company, says the group CEO of Flipkart, Kalyan Krishnamurthy. Let's take a look at the trade setup for the day. The world markets weren't the happiest of places. We'll talk about that. Firstly, the news. And we'll talk about this in great detail, but I'll just dwell upon that just a little bit. The Fed has hiked rates. It's forecasted for 2 more rate hikes in 2019. I think the market went into this meeting with an anticipation that the Fed would be a lot more dovish and there would only be 1 rate hike forecast for 2019. I think as a result of that, plus the fact that Jerome Powell said that Fed will continue to reduce the size of the balance sheet at the current pace. Both of these, one action and one the statement, led to an intraday fall in the market. So the S&P, I think, was up quite significantly, 381 points in the green. It just turned around quite completely. And from the highs of the day, a steep fall for the US markets. As a result of that, I remember the SGX Nifty at a point of time was knocking at the doors of 11,000. In fact, it crossed above it. But if you look at the Asian screen today as well, there's a sea of red. The SGX Nifty is looking at a downtick of about 91 odd points. Nikkei is down about 1.5%. Shanghai is down about 0.5%. Hang Seng too would be marginally in the red. So the world markets are not a happy place today. And we'll start off lower in the session today as well. Very interesting to see what happens though, by the way, because all through the last few days, we've had bullish bets being taken on the index, both the Nifty and the Nifty Bank. And therefore, the question is, what does this 0.5%, 1% downtick do to our markets? Because we have inched up, despite there being a corrective move in 2 of the most heavyweight pockets of the market. IT has been corrective. Private banks in yesterday's session, 2 were down. Despite all of this, we've inched up. What happens today would be very, very interesting. And also very interesting to look at what IT does. Because remember, led by Facebook, NASDAQ corrected quite steeply yesterday. And we've had Nifty IT and select large cap IT names anyways looking like trading at or below key threshold levels. Look at any of these large cap IT names or the Nifty IT as an index itself. Look at the 200-day moving averages, and all of them either have come below those 200-day moving averages. This is TCS, by the way, below the 100-day moving average. Look at any of the others as well. Tech Mahindra is below the 100-day moving average. Nifty DMA, Nifty IT is approaching the 200-day moving averages. Infosys, it's close below the 200-day moving average. So almost all of these large cap IT names or Nifty IT by itself are trading around key moving averages or below some of the key moving averages. And there is weakness out there in IT for sure. So you got to keep that at the back of your mind. Flows were okay in trade yesterday. About 1,200 crores put in by FIs, but DIs taking off about 481 crores. The heartening part was that FIs have continued to put in money, and we were talking about the possibility of this yesterday, because typically if money is coming to the debt markets, equity markets kind of become ancillaries to that move, and therefore not surprised that there's some move. There may have been some bulk deals as well, but not surprised with the fact that there is some money that is being put in. A very important part in today's trade, just before I get to specific stocks, a very important part in today's trade would be what happens to banks. We've heard, or we now know, that the bank recapitalization plan could be announced as early as today, and we already saw signs of some serious delivery-based buying and some high volumes in a lot of these mid-sized banks. So look at Corporation Bank, Bank of Maharashtra, Allahabad Bank. The volume substantially higher than the 20-day averages, and the delivery percentages, at least for stocks like Corporation Bank and Bank of Maharashtra, were fairly high. These are not the normal delivery percentages that you see in these banks. and therefore there was some buying in anticipation of this event. Let's wait and watch what happens today. However, just before we get in and full throttle towards what the Fed did and the implications thereof, just 4 or 5 stocks that I believe we should quickly mention, because these are the ones that could have a reaction either as early as 9:15 or during the course of the day. Firstly, a slew of board meets, and we'll talk about it on First Word, but ONGC, important, they're going to consider the first buyback since listing. It becomes a very important stock to monitor today. Do watch out. Pfizer, and the reason I bring this up is because the talk of town was the deal that GSK Consumer Global has done with Pfizer Inc. But the important news is not on GSK Consumer India, but on Pfizer, because 4 of the most important brands of Pfizer India will continue to remain with the current company, and therefore this large global consumer JV might not have too much of an impact on Pfizer India. So you got to keep that at the back of your mind. The reason I'm mentioning this is that despite the large deal, Pfizer India need not necessarily react negatively or positively. Just keep that at the back of your mind. KPIT Tech, the final approval has come for the scheme of arrangement. They're going to merge and then demerge into 2 separate units. They also have got the approval for the engineering division to be separated into KPIT Engineering. So the demerger scheme getting approval. The stock was active yesterday. Let's see what happens today. Lastly, a couple of small names very quickly. Firstly, Alembic Pharma. There are no Form 483 observations for the APF facility in Gujarat for Alembic Pharma. Do watch out for this one. And Om Metals, fairly skeptical of what this stock does generally, but they won a large order and you got to address it when they won it. So 615 crores is very large for Om Metals. Might react a bit today. However, let's move on to the more important things, and that is First Word and Fed. We'll talk about that. Jerome Powell and his colleagues at the US Federal Reserve chose to ignore Donald Trump's tweets on Wednesday, but have also tweaked their stance on rate hikes next year, trimming it from 3 to 2. Will that have any kind of bearing on the world markets? We speak to Jeffrey Dennis, who shares his view. IT stocks have seen a correction in the last 3 months. So do they now look attractive on the valuation front, or could there be more pain? Agam has the answer. The last 11 months have seen a lot of churn in the two-wheeler space, while Tata Motors has managed to corner a small pie in its utility vehicle segment as well. So Yatin takes us to the latest market share trends across the auto space. And lastly, Sameet Johnson to take us through the numerous board meetings that are lined up today, from ONGC to Coal India and Airtel. What is on the agenda? Very, very important to note that. Let's first start off with the more important news of the day. Defying the wishes of the US President Donald Trump, the Federal Reserve on Wednesday raised the benchmark interest rates. Chairman Powell, however, did hint at lower number of rate hikes in the future. Bloomberg's Kathleen Hayes reports.
The Fed did make a big move today towards a less hawkish stance, but the problem was it did signal it's going to move more slowly next year. At least that's what it expects. Markets were geared up, something for a lot more dramatic. They raised their key rate for the 4th time this year, but next year the consensus is clustered more around 2 rate hikes. They had been clustered around 3. And you just mentioned the nod that Jay Powell gave to slower global growth, tighter financial conditions, stock market falling. I think it's very important. There are many things he said in his press conference that just seem to fall a little bit on deaf ears. A high degree of uncertainty on the rate path. That's what he sees. Let's listen to one very important thing he said later in the press conference.
We know that the economy may not be as kind to our forecasts next year as it was this year. History attests that unforeseen events as the year unfolds may buffet the economy and call for more than a slight change from the policy projections released today.
So again, plenty of hints towards the feeling of 2018 economy was kind to us. We could raise rates 4 times. Unclear what's going to happen next year.
Well, joining us on the phone line from California is Jeffrey Dennis. Needs no introduction, really. Jeff, good having you. Thanks so much for joining in. I think the markets were poised for some dovish commentary, oversold and therefore poised for a bounce. And leading into the event yesterday, the S&P was doing very well. Do you think there is extreme disappointment on the fact that there are 2 rate hikes and not 1?
No, I actually think the markets did get a fairly dovish outcome from the Fed. I think the markets have overreacted on the downside. I think that obviously they raised rates. That was widely expected. That was not a surprise. I think it was unrealistic to expect the Fed to just go from 3 rate hikes next year to 1 quickly. I mean, they still have a decent growth forecast for next year, although, of course, they did cut it. I think that's very important. 2.5 to 2.3 means they are expecting a slightly softer economy than previously. I also think the lack of any adjustment, planned adjustment anyway, to the running off of the balance sheet, I think that played a role in the market's reaction. But basically, the Fed is lining up for a softer economy next year. They will probably not raise rates twice. I think the market's overreacted here. I don't think this was a bad outcome as far as the Fed was concerned here.
So what's working on the market's mind, Jeff Dennis? Because we've had, what, 7, 8, 9%, the worst December since 1931, a number of data points that people can throw. It was probably looking for the Fed to be, what, a lot more dovish than what the Fed has sounded? And what could be the near term for the S&P?
I think the problem is that we've got to all understand the Fed does not react generally to the markets per se. The Fed reacts to the market if they impact the economy. And although the numbers are going to weaken a little bit next year, the economy is still doing reasonably well in the fourth quarter. So you wouldn't expect to see the Fed reacting purely to the markets, although I know the data point that you've just mentioned there, has been a very extreme sell-off in December. So if you were to see the economy softening more than anticipated into 2019, perhaps on the back of the softer market, well, then the Fed would respond accordingly. But I think it also reflects the fact that sentiment is very poor. Investors are concerned about earnings numbers coming down, earnings growth numbers coming down, and of course they're concerned about the risk of a recession next year. And I think the most powerful indicator of how poor sentiment is in the equity market at the moment is the bond market reaction to this decision today, because that was a spectacular rally. So I just don't think we should assume the Fed's going to keep barreling on. If the economy does soften from here, the Fed will be more dovish, less hawkish than they applied today.
Interesting. So would you be happy with the commentary given by the Fed? One is the 2 rate hikes instead of 3. Admittedly, the market wanted more, but let's assume, let's work with this, what's happened, that instead of 3, there are 2 rate hikes. But the Fed also said that they'll continue to reduce the size of the balance sheet at the current pace.
Yeah, as I say, I think that was probably the bigger negative surprise, to continue effectively the quantitative tightening at the speed they've been going. But the fact that they've cut their growth forecast, as I say, by 20 basis points, the fact that they're talking about 2 rate hikes, not 3, it should be telling the market the Fed is on watch for a softer economy than anticipated. And this is why I suspect we had an overreaction. I mean, maybe the markets are thinking the Fed doesn't get it, and basically they're going to lead the economy into recession. I think that's an overreaction here.
Yeah.
I just think maybe the markets wanted a bit more help from the Fed today.
Jeff, just one last question then. What if indeed that point one, that we do have a softer U.S. economy than maybe earlier envisaged, and the fact that the tax tailwind for the U.S. stocks bottom lines will not be as strong in 2019 as it was in 2018, and therefore if the earnings growth is a lot slower, what happens to the markets then? Are the markets preempting that, or is this an overreaction in December which will get bought into?
I think the markets are reacting to that. Clearly, we've seen a big sell-off, and that does reflect concerns about the economy, but also about profit growth going forward. But I think we're getting to quite interesting valuations in the U.S. market, unless you get an earnings recession, which doesn't seem very likely. And I think it's also worth pointing out to your viewers that, of course, emerging markets have held up relatively well through all of this. The dollar's not really moving. Some of these currencies have rallied, including, of course, the Indian rupee. So I think we'll find a bottom in the U.S. market soon. I think the U.S. will probably underperform emerging markets next year, and I think the Fed will give us some help in that general direction. And so my message here is, don't overreact negatively to what the Fed said today, and the market's done that. And so this is pretty much, I think, a buying opportunity.
It's been an absolute pleasure chatting with you today, Jeff Dennis. Thank you so much for taking the time out and giving us, well, a matter-of-facted view on what the markets should do. Really appreciate your time. That's Jeffrey Dennis, and very well noted commentator, really, believing that EMs could actually outperform the US. Not that we've not done that in the month of December, frankly. At some point of time in the day, we'll pull out a chart of what the US markets have done versus what India has done, and you will clearly see the dissection yourself. Anyways, moving on. That's the Fed, and important to address that. Keep in mind, NASDAQ corrected quite a bit, and Indian IT stocks have been no separate. They've witnessed a steady correction over the last 3 months of 2018, but quite steep in the last few days as well. The question mark only is, do the valuations now provide some bit of comfort to anybody who wants to buy into Indian IT? Agam standing by with the potential returns from the sector. And what could the way ahead be fundamentally? Agam, I was just talking in the morning about how some of these stocks are trading around or below their key moving averages. So the technicals are not in the favor. What about the fundamentals?
Well, it's not always you go bottom fishing when the Nifty is at around 10,900
well,
levels.
That's true.
And okay, so in any case, I'll go. We have seen a correction in the IT stocks. It's 9%, down 9% in the last 3 months. So there has been a little bit of correction. I think the question that I was posing, not necessarily meaning anything, is that is this a good time to go along on the IT stocks? Because just about 2 weeks ago, Neeraj, we had done another analysis where we had seen all these IT stocks with their price to earnings ratio for FY19 trade well below the 2-year averages as well as 5-year averages. It's a little bit of a continuation of that study right now, and from what we understand is that most of these companies are still below those averages at this point in time. And we are also looking at your considered trading price to earnings, which is less than 20 times. Again, considering a lot of these stocks earlier were about 20 to 22 times, something like a TCS, or for that matter, Infosys. Of course, the more expensive of the pack, the mid-cap Tata LC was also trading at around 26 times at one point in time. But moving on, the question then I'm asking is whether or not it would be a good time to go in and buy into these companies. Why? Because of the return potentials according to consensus. So let's start off with your return potentials based on your large caps. And as you can see on your screen there, we are looking at an upside potential for TCS, Infosys, HCL Technologies, and Tech Mahindra. HCL Technologies is offering a 22% return even at current levels. This is, of course, largely on well, a little bit of correction after HCL Tech went in and bought some of IBM's assets. Let's take a look at the next set of numbers, and this is where the return potential gets even higher. Now, NIT Technologies has had a fantastic 2018, and yet the street suggests that it could see a 25% gain from current market levels. We've also seen a Mindtree, Emphasis, and L&T Tech all looking at substantial up move. Do remember, L&T Tech has also come off in the last 3 days. So that, again, could possibly be a potential, at least as far as the street is concerned. That is what they are indicating. Coming down to the next set, and again, one of the most expensive stocks on the Indian IT segment right now is Tata LC. It still offers a 27% up move. Cyient is the other one, perhaps the highest among all these companies, 32% upside from current market levels. Zensar, Persistent, and KPIT Tech. Of course, KPIT Tech is where will once again be in focus, considering the NCLT approval for its demerger of its engineering business. But let's also take a look at the risks at this point in time, because we have to address some of these risks. And the rupee strengthening against the US dollar is something that needs to be taken into consideration, considering that big impact it has on many companies which are not fully hedged. And a majority of these companies are not fully hedged. Their hedging positions stand anywhere between 60 to as much as 80%, save for Emphasis, which is fully hedged. Of course, a global economic slowdown amidst trade tension, that is another factor that could bear down on a whole host of these companies, especially given the fact that a lot of these companies, a majority of their revenues come from the US and Europe. In terms of positives, however, what's working out is increasing revenues from digital services, and as we have well documented, variables in the previous 4 or 5 odd quarters where digital services has seen robust growth. There is also a little bit of stagnation in traditional businesses, and of course, this is something that is taking a little bit of a back seat for a lot of these big companies, and of course, it's largely in line with expectations. Let's not forget pricing and cost management. That is also something that is working out in favor of a whole host of these companies. So we'll continue to watch out for some of these factors. I think the only thing at this point in time is working against the Indian IT companies is on a sentimental level, the Indian rupee. But otherwise, at least as far as the Bloomberg consensus is concerned, the consensus suggests that there is a good upside for a whole host of these IT companies.
Well, let's wait and watch. For now, they may look attractive, but they are certainly in the firing line and correcting thick and fast. Agam, thanks for putting that into perspective. Is this a bottom fishing idea? Remains to be seen. I think a lot of people have said that they'll at best remain in line with the markets, will not be outperformers. So let's wait and watch what turns out. The next piece is on automakers, and clearly extremely important. They started off on the fast lane this year, but they have hit many speed breakers on the way. The changing dynamics also caused a shift in market share in many segments, especially in two-wheelers. Yatin Mota is joining us with the highlights surrounding them. And Yatin, it's been a volatile year, to say the least, for the auto names. Yesterday, some big piece of news as well for the passenger vehicles. Yeah. Sum up the trends that you're seeing.
So, Neeraj, of course, the auto stocks are in focus. You always, were mentioning yesterday that, there was M&M press conference and the Maruti, which cut their overall, full year guidance from, 10% odd to 8% odd in terms of volume growth. Of course, this is largely known because the festive season was muted. But post the festive season, for the first 8 months, so basically we're talking about the period of April to November, we have seen certain trends coming in for the entire auto industries, and let's talk about the two-wheeler segment first. Now, we are talking about the market share data as to how really did the companies fare in the last 8 months of this financial year. And to our surprise, we have Bajaj Auto, which has gained significant market share in the motorcycle segment. And remember, their domestic motorcycle sales growth was nearly 30% for this 8-month period. Now, if you look at Bajaj's market share, that came in at 18% versus a level of 15.9%. So almost 200 basis points kind of a gain is what we have seen in terms of market share. What has lost market share is the Hero MotoCorp and the likes of Honda Motors, wherein the market share has fallen by nearly 100 basis points each. TVS Motors, fortunately, has been able to maintain its market share at 7.4% for the first 8 months for the motorcycle segment. For the scooter segment, clearly we have Hero MotoCorp, which has lost significant amount of market share. In fact, they have lost 2 percentage points of market share on an 8-month basis. And however, we have companies like TVS Motors, and on the back of the strong Jupiter launch, we have seen good amount of market share traction coming in there. For the others, the market share more or less remains unchanged on a year-on-year basis for the first 8 months of FY18. Coming to the four-wheeler segment, and Maruti continues to be the market leader, clearly dominating the entire space. Market share 58.5%, and from a 51% kind of a market share range for the past few years, clearly Maruti has broken that band and has moved further higher. So a 58.5% market share for the first 8 months of FY18. Tata Motors as well as Honda have been able to hold ground. Hyundai, however, has lots of market share, but they'll probably build on given the fact that the new Santro launch is there in the marketplace. Also, the mini and compact segment for Maruti have grown by 26% and 62% respectively, and probably because of which we have seen a good amount of traction on the market share front. Coming to the UV segment, and remember yesterday we had M&M, which had unveiled a brand name for XUV 300, and they will be launching that product next year. Clearly, they have been able to maintain guard as far as their market share is concerned. But do remember Maruti Suzuki, which had a couple of new products, the new Ertiga, so on and so forth. They have been slightly range bound in terms of market share in the UV segment. However, Tata Motors is one stock that you need to watch out for. They're doing good in the passenger vehicle segment for the domestic market. We're not talking about JLR, but they have been able to double the market share in the UV segment to a level of 7% versus a level of 3.3%. So significant amount of market share gains coming in for Tata Motors at the cost of Mahindra & Mahindra as well as Maruti. Toyota has been also able to gain market share with the new product launches. These are the broad trends that we get from the SIAM data as far as the first 8 months of FY18 is concerned.
Well, let's wait and watch for the next 4 months hold in store. And let's see what the next 10 days hold in store in terms of activity or action from the government and the impact on the spaces as well. Yatin, thanks for putting that into perspective. That's all about autos. The last piece on First Word today. And that's a slew of meetings that are lined up which might well have impact on the stock prices as well. Corporate boards will consider rewarding shareholders on one hand and look for fundraising options on the other today. For some companies, it's an important day in their legal calendars. Net, a very busy day for India Inc. Sameet Sarkar is standing by to tell us what's on schedule. Sameet, let's start off with the state-owned companies.
So yes, I'll start off with the PSU, and the first one on the list is Coal India, which will be considering an interim dividend today. Now, as of 30th September, the company had a cash balance of more than 39,000 crore rupees, and so far, the highest dividend per share amount given by the company is close to 29 rupees per share. That was announced in 2014. But this time, the amount could be higher than that because in financial year 2019, the company did not have any major capital expenditure plan. The total capex plan for FY19 was close to 9,500 crore. So if you see, the company has option to utilize close to 20,000 to 35,000 crore rupees of its cash on dividends, and if they wish to do so, then the dividend per share could be anything in the range of 32 to 56 rupees per share dividend that the company could announce if they plan to utilize anything between 20,000 to 35,000 crore rupees of their cash, and that would result into a dividend yield of close to 13 to 22% on Coal India. So this stock will definitely be in focus today. The second PSU that will be in focus will be ONGC, where the company will be meeting to consider a buyback announcement today. Now, earlier the company had deferred their interim dividend plans because of lack of funds, and they had said the company would consider a buyback post the third quarter result. But today they are considering this buyback announcement. Now, if you see, the company, as of 30th September, the company had a cash balance of close to 167 crore rupees, only 167, and they are expected to get close to 1,500 crore rupees from the Indian Oil Corporation's buyback and dividend. So this would take their total cash balance to anything close to 1,700 crore rupees. So the amount is very small that the ONGC has in their books to offer for buyback. So this amount, this buyback amount and size could be smaller for ONGC. So this will be the second stock that will be in focus. And lastly, Container Corp will also be in focus because the board will be meeting to consider a bonus issue today. Now, this bonus issue will be cheered by investors because it will help them save taxes post the record date.
Well, interestingly, some private names out there as well, and for Bharti in particular, Sameet, a bunch of actions that could be taken.
Well, yes, the board is meeting today to consider various fundraising options. So let's see what are the options that the company has. Now, the first one would be raising debt, but that is unlikely to happen because the company already has a debt of more than 1 lakh crore rupees in their books, and the leverage ratio, that is net debt to EBITDA, is in excess of 3.7 times. Moreover, the international rating agency, that is Moody's, has put their rating under review for downgrade. So this is unlikely to happen, but this is still an option that the company has. The second option that the company has is stake sale in their tower arm business. This is Bharti Infratel. Now, currently they own 53.5% stake in Bharti Infratel, which is valued at close to 26,000 crore rupees. But this option is also unlikely to happen today because the Indus Infratel merger is ongoing, and it would make more sense for Bharti Airtel to sell stake in the merged entity rather than selling it right now. The third option that they have is selling stake in their DTH business. Now, last year the company did sell 15% of its stake to Warburg in the DTH business, and currently they hold around 80% stake, which is valued at close to 9,000 crore rupees. So this option is open for Bharti Infratel, for Bharti Airtel. The fourth option that they have is stake sell in the Africa business. A few months back, the company did sell some of its stake, which was used to, and the funds that the company got from that was used to repay debt. So this option is open for them. They are also planning an IPO for the Africa business. They could go ahead and sell further stake before this IPO. Currently, Bharti Airtel owns nearly 65% stake in the Africa business, which is valued at close to 21,000 crore rupees. Now, another option that the company has is selling stake in its fiber assets. Now, the actual value of this fiber assets is not known, but this could well likely happen because the company had earlier said that they will be focusing more on their core operations. But analysts also believe that selling fiber asset would not fetch a higher amount for the company. So that's one option that the company has. Now, the best option that the company has and the most likely to happen today is equity dilution. Now, the company can dilute anything between 10 to 20% of its stake through issuing fresh shares, and that could fetch the company close to 13,000 to 26,000 crore rupees. Rights issue is also an option in this because that will also help the promoter maintain its stake in the company. So these are the options that Bharti Airtel has, and they can consider today in fundraising. Now, another large cap stock that will be in focus will be Dr. Reddy's, because today is the last day for Indivior to file an appeal against the Suboxone hearing, which was in favor of Dr. Reddy's. Now, currently, Dr. Reddy's cannot sell this product, and if Indivior fails to file an appeal, so they won't get any extension for that. And Dr. Reddy's can go ahead and sell this product, so that will be a positive thing. But if Indivior files an appeal, which means that Dr. Reddy cannot sell the Suboxone product until the final hearing comes out for this case. So this stock will definitely be in focus today. Lastly, in the broader market, Indian Energy Exchange will also be in focus because they will be considering their first ever buyback since listing. Now, if you see, as of 30th September, the company had a total cash balance of close to 400 crore rupees, which is way ahead of their total net worth, that is just at 289 crore rupees. And the 10% of the net worth is just 29, and if you see the 25% of the net worth, that is 72 crore. So the buyback amount and size could be bigger in this case because the 25% of the net worth is just 72 crore rupees, which is less than 1/5 of its actual cash balance. So this stock will also be in focus today.
So Amit, thanks for putting all of this into perspective. Lots of stocks that could react depending on the decisions that come about. That brings us to the end of First Word. But well, maybe not brace yourself for impact, but settle yourself for some more downsides. But we'll have some very interesting discussions lined up today. Discuss about the Outlook 2019 from Credit Suisse side with Neelkanth Mishra. He joins in just a few minutes from now. And TRAI's new tariff framework for broadcasters with Punit Mishra of ZEEL Entertainment. But after this break, we take a full tilt towards the day's trade.
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. You know, if you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. About going all in. Coming. Product of the Year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture $1 billion.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Welcome back. You're watching IndianOpen right here on Bloomberg Quint. Asian market pack is down in the red on the back of what happened in the US market. Fed Chairman Jerome Powell hiking rates this time around by about 25 basis points. That did not go down too well with the equity markets. Down 1.7% for Nikkei 225. Shanghai is down about 0.5%, and so is Hang Seng. For SGX Nifty, the cut is a little bit steeper, so almost 0.75% down for the SGX. After nudging 11,000 in an intraday trade, the SGX is now at 10,900 odd. You are going to witness some pressure on the currency as well because of the strength in the dollar and a cool off for the rest of the emerging market currencies as well. So the NDF market suggestive of that too. But moving on, the other point and the other aspect to look at is what's been happening in the futures and options space, and how does the derivative market setup this morning look like, particularly for the index and a few specific stocks that have been quite active in the last few trading sessions. Agam.
Well, it's been quiet for the Nifty futures, and it's something which has been a trend over the last 2 or 3 days because the open interest hasn't really changed. The Nifty banking futures, on the other hand, have seen further accumulation in open interest towards longs. Open interest up another 3.6%. Let's move in and talk about the India Volatility Index. Again, this is something that has been on the lower end. Should we see a negative opening, we're likely to see this move higher as well. But coming down to options, and while we have seen unwinding in your 10,800, 900 and 11,000 calls, there's also more writing around the 10,900 and 11,000 puts, and this, however, is likely to reverse if we do see weakness coming through today. Even in terms of your maximum open interest on the lower end, that continues to toggle between 10,500 and 10,800 puts. On the higher end, of course, we continue to see max OI around the 11,000 call. And moving on, when it comes to your put call ratio for the Nifty, that has edged higher to around 1.66. The Nifty banking put call ratio at around 1.36. And in terms of stocks, well, Chennai Petro, of course, one of those which are weak in trade, and we have seen some short build-up, but a whole host of financial stocks which did well yesterday, and Cholamandalam stands out with the 5% up move there. And we also have a lot of traction in Diwan Housing Finance, which has actually seen a 6% up move, even as it sees unwinding of as much as 23% in open interest. So short covering coming along for Diwan Housing Finance as well. Once again, it will be a day in which we will keep an eye on financials and see whether or not well, the dampening sentiment across the globe impacts the kind of growth that we've seen yesterday for these.
All right, Agam, thanks very much for that. That's the futures and options wrap out this morning. Lots more to talk about, but let's not waste any more time and bring in Parthiv Shah, Director at TRACOM Stockbrokers, who's joining us on the show right now. Parthiv, thanks very much for taking out the time. Today is most likely going to be a start in the red, and whether or not it stays there is another case in point. But just the fact that we've seen this move for the last 7 straight days, broader markets have contributed, and you are seeing stocks now making a good comeback. What would be the strategy now to start investing in the mid caps and small caps?
Good morning, David. If I were to see the broader markets, and there's one key reason why this time in this particular whatever rally we have had in the last 7-8 sessions, I think the key reason is the change in a lot of data points. I think oil is something that nobody had envisaged a few months back that would come down to these levels, and there will be such a change in terms of the improvements in the macros. And most importantly, I think what we are realizing from a lot of industrial data is that the capacity utilization is touching the above average mark of 74.5%, which is currently hovering at around 76%. There is genuine demand from a lot of SMEs, MSMEs in terms of credit, and that credit not only being for working capital, but even for the growth. So I think that is also something which is a very interesting data point. And what my sense is that even if we were to check the inflationary data, the core inflationary data is slightly supportive for the industry. No two ways about it. Yes, one will argue about the fact that a lot more capex, the big size capex, would wait out for these 100 days, and once the elections are passed out. So our sense is that the market is a little ahead of itself in terms of trying to build in these positions. The only reason being that once the elections are probably over, one would really be surprised in terms of the quantum of capex that the companies are announcing already in cement, steel, many other sectors. We are seeing that cycle has already turned around. A lot of industrials also we are seeing this positive trend. So I think there are lots of small and mid caps which have corrected in the last massacre by almost 20, 30, 40%. And now probably is a good time to start dipping into some select pockets where I think the management quality is good, the balance sheet strength is extremely good, there are free cash flow generation, and these are the companies which need to do capex, and most of their capex is going to get utilized because of the demand outlay. So I think yes, certainly I would believe there is a lot of opportunity in the small and mid cap space.
All right, it's going to be an important day, with a lot coming out. You've got buyback announcements, you've got fundraising plans. So it's going to be a full board this all through afternoon to see if any of those announcements may have a serious
and a lot of large cap names, Dana. Coal India, interesting. ONGC, interesting. But Bharti Airtel, really interesting because of a bunch of options that they have. Parthiv, what would you watch out for the most in terms of the 3-board meeting? The buyback for ONGC, Coal India, the dividend, or Bharti Airtel, the slew of fundraising options?
See, firstly, I think discussing about the two PSUs, probably my commentary won't be liked by most of the investors in these two stocks. Coal India is always perceived to be a great dividend yield play, but unfortunately, I think with the bureaucracy taking place, this was a company which by 2020 was to hit almost 1 billion tons of coal mining capacities. We are nowhere close to it, and I think that is not at all surprising. Every time, I think any sort of government, talks about big targets, I think these companies are way off. And at a point in time where the demand is strong, there is pricing power, and yet this company is not able to deliver on the fundamental side. I think the government is going to enjoy the cash outlay in terms of the dividend, because that's something that they also need. So never been a big fan of a stock like Coal India, or for that matter ONGC, where the capital allocation is always a very big question mark. Oil, even at almost $85, the stock did nothing, and now oil is down. So I think I don't see a good reason that the buyback, how is going to help. So the capital allocation policy from the government for these large PSUs, which otherwise could have been very big companies, is always a very big question mark. Coming back to Bharti Airtel, I think we always discuss that amongst the telecom names, this is one company that we have liked, and no doubt the debt level is hinging at around 1,14,000 crore. But I think certainly this meeting probably might be a lot about debt reduction and what sort of non-core assets or asset sales they can do in terms of trying to make the balance sheet more stronger. But I think we are sensing that over the next 6 months to 8 months, there could be some sort of pricing power coming back to these companies, and eventually even Reliance Jio, whatever predatory pricing they have had so far, can't go endlessly. So we are waiting for that opportunity wherein a player like Bharti Airtel, if it were to get that 20%, 25% higher pricing power in terms of its data ARPU, there could be a lot of operating leverage kicking in, and won't be a bad idea at this juncture for a company like Bharti to make its balance sheet strong. So any sort of asset sale coming from the African business or from some sort of Indian business, a fiber tower or something, should bode well for the company on the longer horizon.
All right, Parthiv, lots more to talk about, and we lay focus on what's been happening in the banking space and the recapitalization of some of those PSU banks, some of them moving out of the PCA. But that in just moments from now. Let's go across and find out which are the other stocks in news and some of the other brokerage calls that have come in this morning. So Amit, Nikki, both of them here with us. Nikki, let's start off with you. Stocks and news.
I'm going to start off with aluminium stocks. They're expected to be in focus, a negative development coming in for the sector as a whole, given that Trump administration is poised to lift the sanctions imposed on Rusal. That's the biggest manufacturer of aluminium, so we'd see more of aluminium coming in and the prices being affected on account of that. This agreement was reached after the Russian billionaire Oleg Deripaska decided to reduce the ownership in the company by below 50%, and reacting to this development, London Metal Exchange also said that it will lift the suspension on aluminium if US sanctions were to be lifted. Also, we're looking at Tata Motors, given that Fitch rating agency has said that the JLR restructuring would not be enough to lift rating pressure. It has revised the company outlook to negative from stable. Separately, we're also going to be keeping an eye out on Jet Airways, given that the board is going to be discussing, we'll be meeting today to discuss various fundraising options. That's a Financial Express report that we're talking about, along with bunch of few other newspapers which have reported this development. IRB Infra, keep an eye out on this one. The company has bid for second round of TOT package. The first round of TOT packaging was a huge success, so we'll definitely like to keep an eye out on the second one as well. NCLT approval coming in for JSW Steel on account of the proposal made for Vardhman Industry, and also KPIT Technology scheme of arrangement has been approved by NCLTs. Bunch of pharma stocks that are expected to be on focus. You'll be looking at Alembic Pharma, which has received zero observation for its facility in Gujarat, and Wocard, which is the board is going to be meeting on a December 22nd for a fundraising option. And also do keep an eye out on PSU banking stocks, given that India will announce additional recapitalization measures for PSU banks today.
All right. Those are some of the stocks and news. What about brokerage calls?
A couple of them. First one is on Take Solutions, where Axis Capital has initiated coverage with a buy rating and a target price of around 178 rupees on the stock. Now, the brokerage says that there is a large addressable market as the global life science research and development expenditures are growing at a CAGR of around 3%. So that is one thing that is positive for the company. Now, second is the brokerage says that there is a huge opportunity lying in the clinical business, and the company's focus on expansion with organic as well as inorganic growth would propel the revenue growth for the company going forward. On the back of this, the brokerage is expecting the company's revenue and net profit to grow at a compounded annual growth rate of 23% and 30% over FY18 to FY21. The second note we have is on Coal India, where HDFC Securities has initiated a sell rating with a target price of 199. Now, this is the second sell rating for Coal India on the street, and the target price set by HDFC is the lowest in the market. Now, HDFC says that the company's profit growth has been slower than that of the volume growth, which is a negative for the company. Along with this, the pricing power for Coal India is restricted. Now, Coal India's pricing methodology has no profit maximization motive. That's what the brokerage is saying. Now, according to the brokerage, the company's the coal prices are trading at a discount to the international coal prices. Now, Coal India has an option to increase price, but it still does not do it, and it only does it if there's an increase in cost. So that's one negative for Coal India. That's what the brokerage is saying. Along with this, the brokerage also says that the capital expenditure for the company has been rising, but the same has not driving the profits growth for the company but that has not been driving the profit growth of the company. Lastly, it says that the cash richness of Coal India is a myth, because if you see the for the long-term provisions that the company has, adjusting for that, it's a net debt company. So that is a myth that the brokerage is saying that Coal India has.
All right, Sameet, thanks very much for that. Bring you back, Parthiv, on what's going to happen to most of these aluminium companies, Nalco, Hindalco, on the back of the possibility of those sanctions being lifted of Rusal, and therefore the impact on aluminium prices as well.
I think my sense is that many of the aluminum manufacturers in the country, names like Nalco, Hindalco, they have fantastic low-cost base. But no doubt, I think globally, when aluminum prices are correcting, I think we do see a negative trend in terms of many of the listed companies. And I think these companies over a very longish period of time hasn't done anything. Even I remember when the commodity cycle was looking up, the data from Chinese, I think the overall industrial data from China was looking up. Even back then, I think we didn't see names like Hindalco, Vedanta for that matter, because Vedanta is having other business as well. And even Nalco, where I think the alumina prices were looking extremely up, these stocks didn't massively re-rate. Probably, I think in commodities, what we have realized, one thing is that the cycle is good as long as the capacities are being fully utilized. And that wasn't the case because the domestic demand was not firing on all cylinders. So I think, again, these companies could, I think, even if one were to look into these companies post-correction, I think it's a tough call to make unless and until the domestic demand revives fully. Then probably we might see all the benefits of, I think, the low-cost base kicking in. So I would wait on the sidelines. Probably, I believe that one could have a better entry point in such metals names.
Interesting. We'll watch out for these names as well. Parthiv, stay on. So much more to talk about. Let's shift focus a bit to the trade and the technicals and the derivatives. And getting our experts on board. Let's start off with Amit Gupta. He's Associate Vice President and Head of Derivatives at ICICI Securities with us on the show. Amit, so good having you. Thanks much for joining in. App day 2, it's the weekly Bank Nifty weekly options expiry. Very soon, of course, we'll be talking about the Nifty weekly options expiry as well. But how are you approaching trade today? We were in a bit of an uptrend. Today, it looks like it will just get disrupted a little bit. What would you do if we start off about 1% lower?
See, first of all, I am not expecting this monthly expiry also above 11,000 levels. It will be more consolidation. See, Nifty, this is the highest call base, 11,000 call option. And in Bank Nifty, 27,500, that is where the call writers now are sitting. So overall, if you look at, I mean, we started this particular year in the month of Jan 2018, around 10,500 levels. We are still not far away from that. That means it is going to be a flat to positive closings. But recently what has happened after the state elections outcome, that volatility has started coming down quite significantly. So, and that is providing a consolidation mode to Nifty now and a push towards the broader markets move. And that we have seen in the mid caps and small caps, that participation has come in. Now coming to US Fed and its impact on Nifty today, see, it was 80% probability before that there will be hike in the US by the US Fed, but lately, very lately, actually around just a week before, the probability came down to 60% or 65%. So some bullishness people created that there is a possibility that the rate hike may not be there. So because of that, some disappointment is going to be there today. Market may come down by 100 or 150 points. And if you look at the last 2 or 3 hikes by the US Fed, generally it impacts the market by 150 to 200 points only. So that is where I think if you look at the immediate put base, which is placed at 10,800, and I think that is going to be one of the maximum now. So that is going to help Nifty now, and that is going to be a major support. So if Nifty is coming closer to 850 also, I will buy the market for intraday, and then 900 or 930 levels we will try to book it off. So it is going to be more consolidation today, and the declines of 150 points, yes, can be bought.
Okay. What about stocks, and how would you trade stocks this morning, Amit?
Yeah. So when I am coming to stocks, if I relate something to Nifty, among the Nifty heavyweights, then L&T comes to my mind, because the stock has already spent a lot of time, almost 2.5 years now, around 1300, 1250 levels. In fact, since the month of February 2018, it was not able to take out 1350. So this time, when the market was little sluggish before this rally, it tested those 1350 levels and then reverted back. I am not expecting it to fall again back to 1350 now. And just because the US interest rates have risen, and if there is some pressure on the Indian interest rate, this stock may come down. I don't see that reason, because we have seen the scenario of the rate cut, then also it was consolidating. Now the thing is, the people who have shorted this stock, I think this is a time when slowly they are exiting. The buyback is around 1475, and previously in the IT pack we have seen wherever the buybacks have been announced, generally the stocks have taken out those levels. So it is very much possible L&T is moving towards 1475 or 1500 now in the coming days. So if you can buy this stock and short Nifty, I think you will get some alpha out of this, because this is a time when Nifty is consolidating. So we need to identify such heavyweights which can outperform Nifty. In that category, L&T fits. I see limited downsides, and whenever there will be little bit bounce in Nifty, it will give higher returns, and possibly 1500 is on the cards now.
Okay. Got that. So those are some of the stock ideas that are coming in from Amit. We should have Sameet Chavan in a few minutes from now and get his stock ideas as well. But in the meantime, let's move on to our special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock or a trend that he's picked up. Yash, what's on the radar today?
Morning, Devina. So we are tracking Hindustan Unilever on the charts today, and a sell signal coming in on the back of the MACD indicator. Let's first try and understand what it is. So the MACD basically is a trend following momentum indicator. It shows the relationship between the two moving averages of the price. How do you interpret it? You go long when the MACD line crosses above the signal line, and you go short when the MACD line falls below the signal line, which is in the case of Hindustan Unilever. So as you can see, the blue line over here, that is the MACD line, and that has fallen below the signal line, which is the white line, to create a bearish divergence from these current levels. And we have seen a significant rally in the shares of Hindustan Unilever over the last month or two. So probably at these levels one can look at shorting.
And how well has this worked in the past?
So 7 out of the last 10 times that the indicator has turned negative, it would have given you positive returns on an average of close to 4% over the next 10 trading sessions.
All right, that's not bad. Thanks a lot for that, Yash. Appreciate it. That's Bloomberg Edge for you. Let's talk a little bit more about the public sector banks and the news that came out yesterday at more recapitalization now for some of the public sector banks and the possibility of moving out of the PCA for two names. That is, one was Allahabad Bank and the other was Bank of India. Bank of India has been on a tear in the last few trading sessions, and not just Bank of India. If you look at the entire stack up of the PSU banking names, the last 7 days move has been phenomenal. Double-digit gains across the board for most of these names in the past 7 days. Parthiv, how would you read into this particular news that's come out and the possibility of recapitalization happening as soon as today itself?
See, David, I think one can't deny the fact that entire public sector bank basket, I think, has a market share of almost 70%. And there was kind of a lending freeze from most of these banks, whether the ones under the PC action, whether the ones which were not recapped, which generally, I think in the past, if we see, all these banks had this track record of getting a recap from the government, and post which, again, they would start their lending spree. So now probably there's certainly a sense of urgency. The government realizes it, and probably now with the new RBI governor at this stance, which is showing, who's certainly showing a lot of accommodative stance to even have these PSU banks again come back to the market to lend to the MSMEs, to lend to the housing market. Probably we might be, I think, seeing such a move either today or tomorrow. And I think the targeted amount of recap, and initially there was a talk that, the government would be selective in which bank to recap the amount with. But now probably I think they're going to have a sense of urgency. But that is not something which builds well into our investment thesis for many of these public sector banks. We know what happens post this recap. Again, there's another cycle of downtrend in terms of the NPAs. So probably not of the best of the trades. And as such, many of these PSU banks from their rock bottom levels, I think, have already rallied. So I think it's best to avoid this trade even positionally. But I think fundamentally, if one wants to stick to public sector banks, the one stock that we are liking is still Bank of Baroda. I think this is a company where long term, I think there could be a lot of value that can emerge. The management has done a fantastic job in terms of the recovery, trying to kind of mitigate the stressful assets. And going ahead, I think probably this is not a company which will even get any sort of recap from the government. Yet we feel it's well capitalized for the next leg of growth.
Sameet Chavan, Chief Analyst, Technical and Derivatives, Angel Broking with us. We are also about to get a management interaction going. But very quickly, Sameet, last few days when we interacted, you had shown conviction of buying at lower levels and you made money there. What are you doing today when we start off about 100 points lower?
No, I think the bias still remains bullish. 10,800, 750 according to us is likely to act as a very strong support. And in last 3-4 days, what has happened is the put writers have been quite active, and they have been shifting base higher. So from 10,500 towards 10,700, 10,800, now toward 10,900. So according to us, this 10,800, 750 would act as a support.
Sameet, please allow me to interrupt. Sorry, we'll revisit this view, but because we got a management phone going, we'll have to address that because 3 minutes left for pre-opens. Come in, Mr. Mrityunjay Mahapatra, the MD and CEO of Syndicate Bank, with us on the phone line. Mr. Mahapatra, thanks so much for joining in. We, of course, learned that the recapitalization would be announced as early as today. Do you expect the amounts to be given out as well? And what is it that you anticipate from this?
See, good morning to all of you. The discussions are going on for quite some time, and in various tranches, the support that was promised by the government to various PSBs are coming in. And last quarter, we got 728 crores. So the next round, I also read from the papers, are expected after the supplementaries are approved. We have made a claim of around 2,000 crores. Hopefully, it depends. There are various calculations which are going on. Depending on the capital adequacy requirement and the growth capital requirement, we will come to know how much has been allotted.
Mr. Mahapatra, any idea as to when exactly could this happen? We know that the second supplementary demand for grants is being tabled in the Parliament today, but whether or not this comes in the next few days or probably by the end of this month, any idea?
See, banks have made a projection both up to the end of the quarter as well as to the end of the financial year. However, I am expecting that when exactly it will come, though not known, it will be very soon.
Right. So, one more question with regards to, the new RBI governor and his meeting with the PSU banking heads. I mean, if, what's the sense that the industry is getting now post the initial interactions with the RBI governor?
See, we met Governor Das yesterday morning for quite some time, and all the 4 deputy governors were also present. Governor Das opened his interaction with all of us saying that because he has taken over recently, he would like to know the minds of PSU bank chiefs regarding the general sense in the economy, credit offtake, the health of the sector, MSME credit, liquidity in the system, effectiveness of the recent measures that RBI has taken in terms of open market operations, as well as the support that has been extended in terms of relaxation of pool buyout, how these are working and how these are perceived by us. There was no specific discussion as to sense, but what we got was that probably a more consultative regime and a more open regime is coming out. As also, there are some clarifications regarding how RBI is also, required to meet the Basel requirement, because it is an international framework which is evolving. Some of the things are time-bound and the regulatory latitude is small.
Okay. Mr. Mahapatra, appreciate you taking that time and joining in. And
thank you.
Thanks for your time today. Well, that's of course Syndicate Bank, and well, maybe start off with some of the PSU banks in the pre-open session before we talk about the large caps. So let me do that, and we'll talk about the large caps in a bit. Bank of India, Corporation Bank, Allahabad Bank. I think those are the ones that were very active in trade yesterday. Maybe a part of activities already happened. They've already rallied about, in some cases, even 25%. But let's wait and watch if there is more in store. Since we're talking about the mid caps, let me do those first, and then we'll talk about the large caps in just moments from now. But at the broader end of the spectrum, what's looking like making some moves, Quest Corp, it's on news and looks like might start off higher, though early days. So let's wait and watch if indeed this lasts or no. What's not looking all that great, amongst other things, is Tata Communication. Well, I don't know if this will last or not, but it looks like starting off about 8.5% lower. Otherwise, too many moves which are not based on news. So let's give these rates a chance to stabilize. I just want to pick up 2 or 3 newsmakers. KPIT Technologies is a stock in news, and let's see if that is reacting at all. No, not quite. Just a very muted reaction for KPIT Tech as well in the session today. Bajaj Hindustan is all over the place. Don't quite believe this news or this movement. This will change for sure. Quest Corp, stable, 7% higher, demerger. Let's wait and watch if the revised scheme of arrangement does impact the stock or no. And last but not the least, I want to see Tiny Toon, Om Metals. Doubt it will be reacting so early, but large order win. Well, it is reacting. Very sketchy. These moves get sold into. So please be very careful if you're trading into Om Metals. Now, before we move to the large caps, just want to mark the currency and the bond deals as well very quickly. And let's just see what's happening there. Well, 70.58 for the currency. Okay, I mean, yeah, steady as she goes, I would say. It's above 70 and then slips quite strongly. But the bond yield at 7.24, they are exhibiting strength.
In fact, just want to add up a few comments to Quest Corp. Remember, on 10th of December, the promoter had increased stake in the company via open market purchases. Also, yesterday there has been an approval to the amendments of scheme of arrangements between Thomas Cook, Quest Corp and subsidiaries of Thomas Cook. So probably that could have some amount of bearing. But obviously, pre-open ticks and the prices have already cooled off from 7% to about 3%. Moving to the larger names, and IT yet again under pressure. So Wipro, one of your top losers in the session, is down about 2.7%. Remember how we were talking about most of these larger names being at very critical junctures with regards to their daily moving averages and breach of it on the downside. HCL Tech is also down about 0.75%. Tech Mahindra is down 1%. Amongst other losers are Tata Steel down 1%. Hindalco is down 1%. Maruti looks under in today's session. That's another percent given up. Indiabulls Housing, that's down 0.5% right now. NTPC looks weak. HP, BP, IOC, all in the red this morning. Amongst the gainers, you have a handful of 8 stocks gaining on the index. HDFC Bank stacks up as the top performer. That's up 2%. ONGC just 1/3% higher. Z is up 1/4%. So no meaningful gains this morning. For the indices, absolutely flat. Some more stock ideas. We've got both Amit as well as Sameet joining in. Amit, we spoke about L&T as one of your stock ideas. You've got 3 more names, so let's talk about them. Petronet, Asian Paints, and you're selling IndusInd Bank.
So I think one story remains intact is the beneficiaries who are the users of crude. So in that case, paints stocks, I think the kind of move we are seeing right now in this segment, that should continue because they have consolidated for a pretty longer period and they remain quite resilient actually when the market was falling. So people who have tried to go short there, so that closer we are seeing right now. But the open interest now has come down significantly. So Asian Paint is one of those stocks which I think from mid of July, it spent a lot of time near 1250 levels or 1300 levels, and now it is just above those. So my sense is the safety, the margin of safety is very much there. The crude is further down because yesterday after the US Fed announcement, we saw dollar moving up and the crude coming down. So that will give further edge to it just because of the broader market weakness. If the stock is coming down to around 1375, 1378, I think it's a buying opportunity. Look for this. And our target, the first target is around 1440. But I think it should move much ahead above that level. It is just the starting of this stock after a long consolidation. So it also comes into the bracket of L&T because L&T also has gone through the last 2 years of consolidation and then has started moving up. So I think this also falls into that category, another nifty stock. Now from the mid-cap space, I think Petronet is one which we are looking for because this stock had remained near 200 levels for a very long period. And during this period, we had seen a lot of short build-up because people, because oil and gas space was not performing at all in the last few series and most of the stocks were sluggish. So we saw whenever Petronet was moving towards 225, 230, there was short build-up coming in and it was falling towards 205, 210. So that was the range. But eventually we have seen as we are moving toward December expiry, the closer has started in the open interest of this particular stock in the last 2 sessions. I think 3-4% of closer. It's a nascent thing that is happening. So my sense is in today's session, if it is coming down towards 220 or 221, that may be a buying level. Just buy this, look for a target of 234. I think just because of short covering, it can move. And because the rollovers may be lower into the next series also, because the same impact we saw from November to December a little bit, though it was only 5% lower. But if the rollover is lower, I think this trend may continue for a while in Petronet. And as you mentioned, the third stock is in the short side, IndusInd Bank. I don't see that. I have not seen that kind of move in the stock from the lower base. And in yesterday's session also, when the market was stable, we saw 7 to 8% of short addition coming in. So my sense is it is going to stuck up. So one of the best way in this volatility to trade in this stock is you write 1640 call option, which is still trading near 20%. I mean the 20 levels of premium. So if you are selling 1640 call, eventually as you are moving towards expiry, because very few sessions are left now, slowly, because the volatility also will come down, and then because of the time decay, this premium will go off. And I am not expecting the stock to move beyond 1640 immediately. So in that case, you will make money in this.
Okay, Sameet, Chavan, sorry I had to cut you when you give your index strategy. 8 minutes are settling down. 10,885, you're looking like starting off 82 points lower. What would you do on the index?
See, I think we still maintain our bullish stance, that we started last Tuesday, and 10,850, 800 and 750, these are the support zones. So there's a cluster of supports in the zone of 150 points. So we rather use this dip as a buying opportunity. And what is encouraging is the banking index, which has been clearly outperforming Day before yesterday, we saw breakout happening from its recent swing high, and the mid-cap index, which has been clearly buzzing since last 4 or 5 days, and due to yesterday's, massive broader market participation, we saw mid-cap index surpassing its recent swing high. So, which confirms the breakout, and hence we would focus more on individual stock, especially from mid-cap and small-cap space that are likely to provide better opportunities.
What about specific stocks, Sameet?
See, as I said, we are focusing more on mid-cap counters. So all 3 buys would be from the mid-cap universe. First one would be from the cash segment, Delta Corp. After a long consolidation, day before yesterday, we saw decisive price volume breakout in this counter. Yesterday, the stock, saw some kind of profit booking, but we would rather interpret this as a good buying opportunity. Our positional target would be around 280. It can be bought with a stop loss of 243. Apart from this, a lot of PSU stocks, that has been buzzing since last 4 or 5 days. So Engineers India, which has been struggling to surpass its recent hurdle. Yesterday, there was a massive bump up in this counter. If you look at the volume activity in cash segment as well, we saw a massive buying interest. So we expect continuation of this move. Our immediate target would be around 131. It can be bought with a stop loss of 119.3. And our final buy call would be on Indiabulls Real Estate. The entire realty space has seen massive buying interest in last 2 to 3 days. So DLF, which has been our preferred pick within this space, has already moved up 7 to 8% yesterday. So within this space, Indiabulls Real Estate, purely with a momentum perspective, looks good from here on. 8 to 10% is clearly on cards. So we recommend this stock for a target of 102, stop loss at 84.8.
Okay. Stay on, Chavan. Before we take in final thoughts from Parthiv Shah, minutes away from market open, so let's tell our viewers all that they need to know to stay ahead in trade today. First up, watch out for the PSU banks as the government may announce additional recapitalization as early as today.
JLR turnaround plan not enough to lift ratings pressure, says Fitch. Tata Motors may take a knock after this comment.
Likely to start off marginally lower. Om Metals Infra Projects has won a 615 crore order or a contract from Water Department of Rajasthan. The stock likely to start off 14% higher.
Coal India will consider proposal for interim dividend today. HDFC Securities has initiated coverage with a sell rating and has set the lowest of price targets as 199 rupees per share.
On the other hand, the boards at ONGC and Indian Energy Exchange will consider buyback proposals today.
Lastly, NALCO and Hindalco may come under pressure as Trump administration is poised to lift sanctions on Rusal. LME has also proposed ending its suspension on the Russian aluminium company.
Well, they're starting off lower. So before I get to Parthiv Shah, just a quick thought here, Sameet, Chavan. Hindalco, NALCO look like starting off lower. Sameet, would you take a trade on either of them?
See, if you have to take any trade, then Hindalco is the one stock that we are closely tracking. But we would rather wait for further dips to happen. We have a buy call. Overall, if you see the metal space is in a sweet spot, and we believe that Tata Steel, Hindalco are likely to move higher. So Hindalco is the one stock, 215 seems to be a very strong support. It's a multi-month support as well. So if this stock, comes around, say, 220, 222, we would rather interpret this as a buying opportunity.
Okay. Parthiv, did you have a look at the demergers and the announcements that came off, one for KPRT, the scheme of arrangement, or Thomas Cook, the revised scheme of arrangement as well, and any thoughts that you want to share?
So I would like to comment on Thomas Cook scheme of demerger. See, frankly speaking, I think what I sense is that this management coming from Fairfax, I think Prem Vatsa, they are fantastic capital allocators, and they've realized that Thomas Cook since so many years hasn't really delivered anything in terms of proper shareholder returns, despite having all the right businesses, despite inorganically also investing. So now I think my sense is that they're trying to work on this single entity, not being more like a holding company structure, but more like an entity which can create some shareholder value. And probably this is one vehicle through which Mr. Prem Vatsa has made a lot of investments in the country. So I think the valuations are not at all stretched, and Thomas Cook as a company is something we have really liked as a business model. And I think the faith that one should have in terms of a good capital allocator like that of Prem Vatsa and Fairfax Holdings, I think should reinstate the confidence. So I think someone having at least a 3-year time horizon, Thomas Cook, I think could deliver a very good set of returns.
Okay, that's Thomas Cook. Pre-open up about almost 2%, 238 on the counter. We're almost 2 minutes down to market opening. Anything else? We'll be talking about IT and most of the bigger IT names being very close to breaking down below some of the important daily moving averages. Sameet, for the larger names like an Infosys, Tech Mahindra, HCL Tech, Wipro, what would the call be now?
No, clearly in last 3-4 days the entire IT space has underperformed, and if we look at the Infosys, we had a whipsaw around 690. The stock managed to surpass this hurdle, which was followed by another 2 to 3% up move. But again, in last 3-4 days, this stock has seen massive nosedive from higher levels. So all in all, we expect underperformance to continue, wherein the Nifty IT is likely to consolidate. TCS, the one stock that has been consolidating and has been struggling to surpass its multi-day high somewhere around 2030. So as long as it remains below that level, it is likely to consolidate. But within mid-cap IT space, KPIT is the one stock that was clearly on a roll yesterday. We saw massive bump up with sizable volumes. Hence, any minor dip toward 226 would be a good buying opportunity in case of KPIT Tech.
All right, 40 seconds left to go for market opening. Quick top calls from both our technical experts, 10 seconds each. Sameet, let's start off with you.
See, I'll stay with Delta Corp. Looks good. Our target remains at 280, stop loss around 243.
Amit?
So I think Petronet, because it has not pulled up that much, so a fall towards 221 may be a good buying opportunity.
Gentlemen, Sameet, Chavan, Amit, Gupta, thank you so much, gentlemen, for joining in today and giving us your thoughts. Parthiv, stay on. We'll just take in opening thoughts from you post-market open. But here's how the markets are likely to, or the market's just about to start off. We'll start off in the red. The question mark only is, do we bounce back or do we stay lower in the session? 4 days until the next expiry as well. Well, 0.75% in the red for the Nifty 50. Nifty banked to about 200 points lower. But, well, contained from the looks of it, not too damaging, but let's wait and watch what happens. Mid caps and the small caps, I would reckon, would have started off lower as well. So mid cap index certainly, small caps in here start off with a bit of a lag. Let's bring up the heat map and show you what's moving and what's not. Wow. But look at the quantum of red on the screen. Not that too many stocks have cracked too deeply. The likes of Hindalco, Vedanta, etc. are down, and some bit of a pullback on finance and FinServes, etc. So some of the trading calls given yesterday might not quite go ahead. But well, a fair bit of red, very little green. Essentially, the mood isn't quite exactly the strongest. So that's the verdict on the index. Fair bit of red on the screen, but I must say, just about 0.6 or 2/3% in the red, the key indices right now. Let's wait and watch. We've actually been doing rather well for ourselves. Let's see if that lasts. Before I hand it over to Devina for what's happening across the markets, 2 or 3 pockets that I want to highlight. Firstly, stocks which are trading near new highs in trade yesterday, somehow not quite being able to move up in the session today. Naturally so, because the market started lower. But do watch out for Marico, Pidilite, Bata, that consumption story well and truly kicking. What about some stocks which are in news today? The Rusal impact for stocks like Hindalco and Nalco, and they're starting off lower, 2.5% lower for Hindalco, 3% lower for Hindalco and Nalco, about 4% lower. Aluminum prices certainly in the pressure. We'll be talking about it a bit later on in the show as well, a discussion on that. But yeah, these stocks are definitely starting off lower in trade. But Devina, what about the broader end of the spectrum? What are you spotting?
This week, the start is slightly more somber. So you've got the likes of JP Associates down 2%. You've got GMDC down 1.8%. Shrey Infra down 1.5%. Remember, yesterday's session saw a lot of play on infrastructure. There was interest in housing finance companies. These were the names that did really well. So today's session, some profit taking off the table, and just that the market mood itself is a lot more negative this morning. IRB Infra is down about 1%. You've got Ashoka Buildcon down about 1.5%. NCC is the other one that you should watch out for from the infra pack. That stock, though, still holding up about 0.5%. PSU banking names, that's the focus yesterday's session. So all of them seeing a major uptick, not just the bigger names, but the smaller PSU names as well. The likes of a Bank of India, you've got Bank of Baroda. Bank of India is still up, so it's still managing to hold a ground, 99 now. From 90 to 99 in a matter of 2 trading sessions. Allahabad Bank down 0.25%. Corporation Bank up in today's session. Then you've got an Indian Bank, United Bank, Union Bank of India. You know, just a whole host of banking names that are somewhat stable in today's session. Capital First is seeing some profits being taken off the table. Yesterday, completion of merger with IDFC. Stock was up 5%. Today, the stock's down about 1%. Zensar Technologies is down 1.5%. You've got the likes of Chennai Petro, which is down this session. Magma, FinCorp, VIP Industries, some of the other losers. Gainers, JK Tyre, 6%. On the counter, that's at 109 right now. IndianOpen Transport 2% higher, HDIL up 2% as well. KPIT Tech, that's up 1.7%. Syndicate Bank, we just spoke to the management, stocks up 1%. Jet Airways moves up, and the other PSU banks are all in the green as well.
Well, Parthiv, just before we thank you, Kesoram as a stock in focus, 8% higher. Final question to you, 89.5, 90. Any thoughts here?
See, Neeraj, I think this was a company which we did long back, but then I think after the mishaps in terms of the corporate governances and all the hopes that were shattered after they sold the tire division and talks about debt deleveraging, the QIP they did, I think not the best of the companies to invest into. If one wants to bet this company as a cement play, because then eventually they're going to have that as demerger, I think there are far better names. And if at all the cement part goes to Ultratech, which is eventually probably the case in point in terms of succession. We saw what happened with Century Textile shareholders for the cement division went to going to Ultratech. We are not sure we'll get the right value or not. So I think Kesoram certainly would be a stock that we would avoid.
Okay, we leave it at that, Parthiv. Thanks very much for joining us. Appreciate you taking out the time. Moving on, Neelkanth Mishra, Managing Director and India Equity Strategist at Credit Suisse, is joining us on the show right now. Neelkanth, thanks very much for taking out the time, and it's important to get your opinion on a day like this. You did have the Fed coming out with its 25 basis point hike, though the outlook has been trimmed to just 2 hikes in next year versus 3. Global setup now gaining more prominence than what's been happening in terms of domestic indicators for our equity markets. How would you place us right now in the run-up to more volatile times ahead of the election as well?
Right. So, see, globally, we are in a situation which we haven't been in for the last 2 years. In the last 2 years, global growth estimates were being continuously revised up, even though marginally. The period before that was where global growth was persistently being revised down. And I think we have now, in the last 6-8 months, reached that point where, again, global growth estimates are being questioned. I think we are seeing, we should see more downgrades in the coming quarters. Some of the signals coming from commodities are not very encouraging. So the first leg down of oil was mostly supply driven. I think the supply constraints that were feared didn't really come around. Then there was a technical correction where long positions were unwound, but the last leg down is actually very worrying. It suggests that demand is coming off very sharply. Now, the central banks have been on a tightening, have had a tightening trajectory. The global central bank balance sheets are expected to shrink by $430 billion in the next 12 months and about $900 billion in the next 24 months. Interest rates were to be hiked, as you just said. The Fed was expected to hike by 3, now they're saying 2. Some people were at 4. I think they'll have to all cut their estimates. Now, for the central banks whose primary mandate is the economy to actually transition or change their rate guidance or rate hike expectations, you need to have significant market volatility. And I think that's what we are seeing right now. So for those changes to happen, I think the global markets in most of the foreseeable future, I think, will be quite volatile. Coming to India and the implications, see, net FII buying in the last 3 years has been close to 0, as almost insignificant as a percentage of market cap. On the other hand, domestic flows are at $15–20 billion a year. That, I think, provides a lot of stability. But we have to be very cautious in the sense that India's price to earnings premium to that of the world is now already nearing its last 7–8 year highs, and that's something that can act as a cap on price to earnings. So as the domestic economy slows, I'm actually less worried. If you're taking a 12-month view, I think the election should be not that important, in the sense that they cause a lot of news flow, they cause a lot of volatility, there's a lot of noise. But if you look back the last 20 years and looked at market performance 180 days before and 180 days after election results, there is no visible change in direction. So it's actually the economic momentum that and perhaps flows, domestic flows, that will decide the prospects. And on the economy itself, I think the signs are not that good. There are the economy started weakening much before people had expected. There was a statistical weakening. What I call that is, the second half last year had higher growth and therefore had a higher base, and therefore visibly or statistically the economy growth rate was supposed to correct in the second half. But it started weakening even in the second quarter, and I think the 7.5% kind of growth rate for FY20 now looks very difficult. So those are things that I would worry about. I think the global markets, I don't think have been stable for a while, so I think that will just continue.
Neelkanth, is there a shift in the theme that investors are keeping in mind while investing in the Indian equity markets? So up until now, where consumption-driven names were key in focus and consumption as a theme held the spotlight, is that transitioning towards something else, like probably more capital-intensive spaces, more investment-driven spaces, and that could be the next driver?
All right, excellent question. So I see the consumption as a theme, I think, has worked for the last 8 years. In fact, some would say that, and in absolute terms, it's actually never really corrected meaningfully. It's just that it is outperformed meaningfully in the last 4 or 5 years, and investments and industrials have actually not done so. See, there are a couple of things that are changing. The first is that there is the pay commission. I think the pay commission is a very, very large consumption stimulus, and a very potent one, in the sense that if in the private sector, I mean, most people are not really clear till the day they get their bonus as to what the bonus is going to be. And secondly, the pay hikes, you can never assume that they will be there forever. In governments, for public sector employees, the hikes happen once a decade. They're very well flagged. You know that within the first 1 or 2 years of 2006, 2016, in the case of seventh pay commission, that the hikes are coming. More importantly, that it's a step jump. So it's once you are at that level, it's very unlikely it's ever going to come down. So the impact on consumption of something like that is actually very, very significant. And so we've gone through, so that the sixth pay commission was a bit delayed. It was supposed to start in 2006. It was announced in the middle of 2008. It really started happening in 2009. And then the state governments kept doing it till 2010-11. We saw 2-3, and then it happened that 2014-15, I think, was a lull, but 2016 onwards, again, the implementation started. So we've seen a period where very large increases have happened to government salaries. In terms of quantum, the seventh pay commission, we estimate, added about 4.5 trillion rupees, 4,50,000 crores per year to the salary and pension bills of state and central governments. This is a huge stimulus, and the impact of this was, I think, felt very much on the discretionary space, and I think second order effects also to some extent in the staple space. And as we proceed forward, I think there will be a lull as the non-government incomes now need to catch up to support the car sales and the two-wheeler sales and all that. The problem is that income generation depends on GDP. So if GDP growth is not really accelerating, then it may take longer for that base to catch up. And I think we are due for some disappointments. I mean, we'll discuss the loan waiver issues perhaps if you want to, but the point is that I think consumption growth has been slowing, and I think it will continue to slow in the foreseeable future. And that's not something the market's really geared up to. Investments, on the other hand, it's a part of the business cycle. I mean, if you set up 40 million tons of steel capacity in one go, and your base is 60 million tons, it takes 5-6 years to fill that up. But once that is filled up, you don't really have an option. You need to set up the steel capacities. There is also serious supply constrained sectors where we have, because of political will, because of just the fact that we didn't know how to do it. I think those issues have constrained supply addition in sectors like water management, sewage management, and urban infrastructure, metro rails, say railway infrastructure. And some of those investments are now starting to happen, and they are supply constraints. So there's no reason why these need to stop fundamentally. And therefore, our view is that given that the market absolutely doesn't price in any improvement here, that partly because the capacity in the economy is now filling up, and partly because the governments at the pace of GDP growth will keep doing some capex, we think that the sustainability of this GFCF recovery, the gross fixed capital formation recovery that we've seen in the last 6 quarters, is for much longer than what the market pricing in, and that's where the investment opportunities lie.
Interesting. Neelkanth and Neeraj here, and well, always good having you. Twice in 10 days. It's a pleasure. Let's just talk about the point that you mentioned, the farm loan waivers. And it's from a market perspective, how big a worry could it be? One, I think you made a reference, passing reference, if I'm not wrong, to maybe GDP slowdown that could happen as well. Are you also worried about the fact that if 2 states or 3 states have done it, over the course on the build up to the general elections, more states may do it, and that is the pressing worry?
Yeah, the pressing worry in my view is the announcements, not as much as the fiscal side. So let's look at it a bit more holistically. The first is that many big states have already done it, right? So Andhra Pradesh, Telangana started it off 2015. Then we saw UP and Maharashtra. Then we saw Karnataka, Punjab, Rajasthan. Tamil Nadu did it for the cooperative banks 2-3 years back. So it has been, and it's not that big a political issue yet in Bihar, Bengal, and Odisha, partly because there's not that much of institutional credit that has actually been issued there. So there's not too much more to happen, if you ask me honestly. The second is that fiscally, we have to keep in mind that, and I think the state governments have to keep in mind that their fiscal deficit ratio is actually capped. So under the Constitution, Article 293, every single rupee that they borrow has to be with the permission of the central government, and the central government does not allow does not allow states to breach that 3% level. So the year in which UP did the loan waivers, and it also had to implement the pay commission, it did nothing else. So there was no other expenditure increase that happened. So in terms of aggregate handout, so if you spend so much on farm loan waivers, someone has to pay for it, and that payout could happen because there is no additional spending on agriculture or on education, on healthcare. And therefore, the net economic impact of that is more redistributive than just really the fiscal stress. The bigger issue is that this is the least potent of a government spending in terms of a fiscal multiplier. See, as the government spends, if you build a road out of it, the multiplier in the first year and 3-5 years out is actually very high. If you even hand it out to people, there is a meaningful number. If you do a loan waiver, actually there is very, very little impact on consumption because there is no fresh cash going to the farmer or to the individual. And what happens instead is that in a hurry, you announce a farm loan waiver, and of course it's a political statement, that's the reason why it's done.
Right.
But the implementation of this could take 6 to 12 months at least, and there are states which have been struggling with 24 months. In the interim, the banks, because the farmer just says, okay, the farm loan has been waived, so I'm not going to service my loan, the banks just stop issuing fresh loans into those geographies. And so the inflow of fresh cash into the economy actually slows down. So it actually has a very, very bad effect on economic momentum.
Yeah, maybe that's something that is that's something that you are baking in.
So,
please make your point. Please make your point.
No, it's okay. It's okay. So I think so there are multiple issues here. The first is, of course, I think the market just takes there is a farm loan waiver, so there is like a dole, but that dole does not drive higher consumption. So I think some of the market reaction on that front is I think a bit premature. If the read-through is that this means we will see more and more such policies because this is turning out to be a big political issue, and that's actually, if that is the view, then well, there is some rationale to it, but I suspect that is not what people who are buying these stocks are thinking. What I mean to say is farm stress or agricultural stress, I think, has been there. We've been flagging it for 2.5 years that it's a problem of surplus. We don't know how to handle it, and I think policies are only now starting to change towards that. But it's not going to get resolved in the next 5 years. So I think this is going to be a persistent point. I think the governments need to figure out ways of handling this. The expectation that a scheme like Raitu Bandhu from Telangana, where 4,000 rupees an acre were handed out in checks twice a year for every season, it is not possible for other states to do it. I mean, first thing, you don't have clean land records against which you can do it.
Right.
Secondly, Telangana, even in the first year, was spending 12,000 crores, 1.5% of GDP. That's not something that any state can afford. So, so this is, as a change, as a policy priority is there, but I don't think the spending will really happen.
Another market dynamic now is going to be the coming of the new RBI governor and the stance that he takes within the given framework and what it does for the financial industry and how that changes things around. I mean, he's worked on both counts. He's worked with the government as well. He's worked in close quarters on the finance ministry, and he's open to dialogue with various stakeholders here. So do you feel that this could be, you know, a silver lining now, and a little bit of relaxation could be seen for the financial space as a whole, and particularly for banks now, and the turn in the investment rationale?
So, okay, I said that's I think we've discussed this before in Neeraj's show. The point is that, you know, most governors before the last two used to come from the finance ministry. So I don't necessarily fear for the worst when it comes to RBI independence, etc., just because the new governor has worked in the government, because it is about the institution they're working for, etc. So I don't think it will just, that the views will be colored by the fact that they've worked in the government. But coming to the policy action itself, see, I think the Monetary Policy Committee has made it very clear that they're only focused on inflation. They have come in for some criticism. They were when the rupee was falling and people thought that they should slow down the economy even more. But they said, no, we are only worried about inflation. And, well, inflation is now down, and they have cut down their forecast. They did not change their stance in the last meeting, but maybe now they change their stance and the rate cuts happen. So independent of what, so this is the point of having a monetary policy committee, right? That you have some institutional continuity, that there are 5 people who are going to be the same out of 6, and the fact that it's a formula-driven process, more or less, at least from what they've guided to. And if inflation follows the trajectory it is following, then rate cuts are obvious, right? It's not rocket science. The bigger issue is the financial system's ability to lend. See, there is a shortage of capital. You know, if non-banking finance companies, of course, I don't think, I mean, with this kind of liquidity injection, I suppose failures are very unlikely. But where is the capital to grow? If NBFCs, the non-banking finance companies, are not willing to grow, or are at least till March, April, are going to constrain themselves from growth, where will credit growth come from? So all of these open market operations the incredibly high amount of liquidity that is being injected by the RBI, will it really result in higher credit? And that's the big question mark, because based on the availability of capital, based on the growth in equity values of financial firms, it doesn't look like there will be space to grow aggregate credit by more than 10 trillion rupees, which in the financial system, overall financial credit means only about 8-9% growth. How will the economy grow with that? And the bigger issue is that despite the fact that so much of currency has been printed, is the currency really moving into the right hands, in the sense that the repeated feedback that we get from our channel checks, our field trips, and other people doing the same field trips, and companies now increasingly, is that they feel that there is not enough money in the market. Right. Now, this is all anecdotal and of course not very scientific, but is the cash really going where it is needed? So it is a very monetary, it's a very deep monetary problem, and I think those are the solutions that we should look forward to. I think the issues about like OMOs themselves, I think are a sign that the RBI does want to provide liquidity. I think the next question will be, how do you make it available to the borrowers?
Yeah, and I think time will tell and give the answers to those questions as well. We could go on and on, but out of time completely. Neelkanth Mishra, so good having you. Thanks so much for joining in. And viewers, a small brief around this conversation and the report that Credit Suisse has come out with will be on the website as well. So do log in and read up that too. But time now to take a very quick break on the note that the markets are down about 0.5%. On the other side of the break, we've discussed the new tariff order from TRAI framework for broadcasters with Punit Mishra of ZEEL Entertainment.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out there.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that is sustained.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
TRAI's new tariff order comes into effect from December 29th. And how will this impact broadcasters, consumers and distributors? Joining me today from Mumbai is Punit Mishra, CEO Domestic Business for ZEEL Entertainment. Punit, thank you very much for joining us on Bloomberg Quint. To begin with, let me start off with the structuring that you have done for your channels, because the TRAI final notification came in. So can you just take us through what kind of structuring you have done for your bouquet of channels and at what pricing it has been done?
Thank you, Sajid, for having me here on your show. For us at ZEEL, one of the things that is most important to us, and that's what we have been driving within the organization for the last few years, is that the consumer is the center of our attention, and the consumer is really the reason for our existence. And in that context, the TRAI pricing order that comes into effect from 29th December is something which really is, it works for us, because what this pricing order does is that it gives the power of choice in the hands of the consumer. Consumers have the liberty to decide what channels or bouquet of channels do they want to watch, and for that price that broadcasters put for it, is it something that is of value to them or not? So the way we see it impacting our business is that what was already a journey we were on, we just have to make sure that we further accelerate that journey of being very focused on our viewers. We have to ensure that they keep loving us and will then be willing to buy our product. Now, the way we have designed our bouquet, which is what the question that you were asking, we studied the way consumers consume content. 3 genres account for almost 85% of their daily consumption, which is general entertainment, movies, and news. And we at ZEEL have a very strong bouquet which has all these 3 genres plus the additional genres of lifestyle and music. And that's what we've put in our base bouquet at 45 rupees. What we believe is that with this order, there is going to be a process of selection in the families. As we say, channels ka chunav hoga gharon mein. That's what we are using as a line. And we believe that with this offering, people will choose us, families will choose us, because we are offering them the right bouquet at the right price.
When you say you have multiple genres and you're pricing the base bouquet at 45, does it mean that all those genres combined together as a bouquet comes to the customer at 45, or is there a separate bouquets for maybe entertainment, for news, or for lifestyle, or regional for that matter?
So we have some total of some 68 bouquets that we have created. For example, for each of the language channels, there is a different bouquet that's been created. For consumers who opt for, let's say, viewing English movies and so on, there are separate bouquets. For HD consumers, there are separate bouquets. So we've made sure that from the point of view of an understanding of various segments of consumers, we offer enough bouquets so that it makes the choice easy for viewers. We are aware, however, that actually at the end of it, theoretically, as many homes, that many bouquets will end up, because people are at home level going to choose, right? So that many million bouquets will end up existing independently in terms of every consumer home being an independent bouquet, right?
Yeah.
So what we have tried to do is to combine our powerful channels in simple choices for viewers and priced it such that people will find it A, convenient, and B, attractive on pricing.
Is it fair to say that all your channels together now are pay channels in that sense and are part of the bouquet?
So there are some channels which are available on a separate platform, which is the Free Dish platform, where there are some channels, because that's a platform which, from our understanding, is a separate platform, not part of the pricing order. And that's where there are some channels available as free to air. But for all pay platform consumers, all our channels are part of the pay bouquet only.
Okay, I wanted to, the reason I was asking you is that you're going to see some kind of disruption happening for at least a couple of weeks once this tariff order comes into place from December 29th. Do you see some impact in the short term with respect to subscription revenues coming in as consumers start, creating their own bouquets? Every family may not require entire 68 channels or of either Zee or maybe similar amount of channels from other competitors like Star or Sony. So they will pick up one channel each to create their own bouquets. In such a scenario, do you see a disruption happening with respect to subscription revenues?
The way we look at it is that consumers have already rewarded us by giving us the viewership share that we have. The fact that if 2 years ago we were 15.9 share and today we are 20 plus share means that consumers have already rewarded us by making the choice for us. The way that I would look at it is that if my subscription revenue was 100 rupees 2 years ago, today if my share has gone up to 20%, my subscription revenue should be accelerated on growth. Now with this new tariff regime, the way I look at it is that consumers having the choice, they've already shown that choice by picking us up, by spending their most valuable commodity, which is time, which is what is measured by the rating system. Already they have shown that love for us. So the way we look at it is that the guidance that we have maintained on subscription revenue for us as an organization will continue to be the same. We will deliver on that growth, and that is something that we are very confident of. In the long run, the more viewership share we garner, we would imagine that that should account for more subscription revenue as well.
Are you also providing discounting with respect to a la carte channels, because the tariff order allows for discounting for a la carte on a 90 plus 90 day format? So are you looking at that as well for people who are trying to subscribe to a la carte channels of the Zee bouquet or Zee group?
So I think that's what we've done with the pricing of the bouquet that I was talking about, which is our family pack, priced at 45 rupees, where we have bundled the channels that we believe offer great, which will be watched by people and offer great value to them, and it is at a discount versus the a la carte price. And that's what has already been factored in all our bundles that we have created.
And do you have any clarity on the discounting part of it? Because that's something which is a little bit unclear from the broadcasting point of view. And we understand TRAI has also approached Supreme Court to get a clarity on that. The maximum amount of discount that can be put on a bouquet compared to the sum of the total of a la carte channels which are part of it.
See, our understanding is very clear that the amount of discounting is the choice of the broadcaster, and that is something that is in sync with the whole consumer-led pricing mechanism, that it's an open market operation. You have the power of choice and you have the power hence of the discount. The power of whether people will choose you for those prices is really the power of the consumer, and if you have priced yourself wrongly, then they are going to punish you. If you have priced yourself correctly, then they will reward you. So our understanding is clear that pricing, and that includes discounting, is the discretion of the broadcaster. Whether people choose or not is their discretion for that choice.
The reason I'm asking this is because the entire controversy is with respect to the TRAI tariff order, which talks about maximum discount allowed on a bouquet is 15% of the total value, as compared to the Madras High Court order, which does not put a cap on discounting. And because the Supreme Court order didn't mention anything on that, there's an ambiguity with respect to the kind of discounting. If Supreme Court in early 2019, when it looks at the special leave petition of TRAI, goes with what TRAI has to say, will you be looking at repricing of bouquet or channels again? Will all broadcasters be looking at the same way that you're looking at?
I think we are very clear that when we have priced our product post whatever discount we are giving, that is the fair price that we believe needs to be charged from our viewers. And we would leave the power of choice with them, which is the spirit of this order. We would, as a network, support the fact that we should retain the right of the discount. And as you said, this is something which the Madras High Court has already ruled, as far as our understanding goes, that the discount is something which is the privilege of the producer or the supplier. And we are expecting that to be withheld. As you said, it is something which TRAI has asked for a clarification, and we will await that, but our understanding is that the clarification has already been given.
Punit, I have two more questions, and those are specifically from a consumer's point of view. We've seen a trend of consumers looking at content costs on a monthly basis, and broadcasters are designing their bouquet accordingly. But we are also seeing a trend of more consumers going for OTT platforms like Netflix or a Prime or maybe Z5 for that matter. Do you see, how do you think consumers are going to act now, because there is a content cost which is coming in on a monthly basis for them, and now that this flexibility of a la carte rates are coming, do you see the industry as a whole disrupting because of that?
I think I would give much more credit to our viewers in terms of what they want to spend their time and money on. Our reading on this has been, I use this phrase a lot in my business, which is more is more. We are seeing consumption growing on television, and we are seeing consumption growing on the digital platform, because our understanding of it is not about consumption in one platform versus the other. It is about the total pie of consumption of entertainment growing. There are different kind of consumer needs and different kinds of consumer segments who will find different platforms suitable for them at different points of time. And hence, we are very happy to see the overall content consumption pie growing. Our role as people who are providing content both on television as well as OTT platform, as you mentioned Z5 as our digital platform, our role is we need to be winning on television and winning through viewership share. We need to win on digital through viewership share. And the core competence that will come to bear is great content creation for the consumer need that we meet on those platforms. So we see this as I said, more is more, and we see both growing. We see revenues on both growing. We see subscription revenues as well growing. So we are very bullish on both going forward. And as the other phrase that we use, we see this as an and world.
Okay.
This and that both will grow.
No, I get that point, what you're saying, but my point is from more of a consumer cost point of view, because at the end of the day, he's going to shell out the money not only for the linear medium, but also for the digital medium. And as the younger generation is moving towards the digital medium, the cost per household for content is also something which will come into play. So how does broadcasters like you, handle that kind of situation?
So I think the first thing that we have to dispel as a notion is that there is a very linear comparison of baskets of purchase by category in households. Households have a certain outlay of money, and they are not comparing within category consumption. They're looking at the total outlay of consumption in various needs they have. Whether it is food, whether it's entertainment, whether it is education, there is a full outlay or a budget that they are operating with, and they have the flexibility to titrate one category versus the other based on whatever is their requirement. And that is where to say that if consumption grows in X on television it grows, or in digital it grows, will there be a commensurate negative impact elsewhere? I think the consumer behavior will not be as linear and as simple. In fact, it will lead to a lot more complex consumer behavior, and therein lies the opportunity for broadcasters or digital platform players. I mean, I'll give you maybe not a direct example, but if we go back to the days when there was, landline phones, people used them for conversation. Then came the regular mobile phones, and people used them for maybe messages and phone calls. And then came the smartphone, which people started using for a lot more. And it's just that the overall consumption or the need kept growing, and people have then titrated how much they want to pay for, say, the telephone service versus the TV service versus eating out and this, that, the other. So it is a much more complex behavior of consumers than a very direct, oh, I'm consuming more of content here and paying for more here, should I pay less there? I'm not seeing that play out at all.
Okay, but it is surely a challenging time for both for the broadcaster, the distributor, and for the consumer. It's a question of choice now. Thank you, Punit, joining us today for a discussion on this pricing, which is going to come up from December 29th. Thank you very much for joining us on Bloomberg Coin.
Thank you very much.